The 16th largest bank in the United States just failed. Let me explain to you why in very simple terms. So here's the thing. The Silicon Valley Bank just failed right now, was taken over by the feds. Now, here's why they failed. First of all, they had money from all the venture capitalists. Silicon Valley obviously is really big on big investments and stuff. They're sitting on billions of dollars when everything was good a few years ago. Well, when everything was good, interest rates were really low. At that point, they're sitting on billions of dollars of deposits and the bank is not doing anything with it. So the bank decides to invest it in bonds. Now that's a good, smart thing because bonds is the government-backed securities. So bonds at that time have a high price. The price of a bond when interest rates is low is high, and when interest rates go up, the price of a bond goes down. And that's the problem right there. So when the interest rates were really low, they bought a whole bunch of bonds over here, right? They bought billions and billions of dollars worth of bonds because they're sitting on all these deposits. So then what happens is inflation hits. The Fed raises interest rates. Interest rates goes up, bond prices come down, and on top of it, because we're in a more difficult economic situations, the venture capitalists take a lot of their money off the table and pulling it out of the bank. So when they're pulling it out of the bank, what does the bank have to do? They have to sell the bonds. But the bond prices now are way lower. So they have to sell the bonds and they're basically incurring a huge loss. They bought it at X and they're selling it for half the price. So if they bought $10 billion worth of bonds, now they're selling it for $5 billion. The bank has a $5 billion loss. And at some point of time, it erodes their equity. Banks can only operate if they have a certain amount of equity, a certain amount of deposits, a certain amount of reserves in their own bank account. And if they have to sell bonds in order to pay back their customers, their deposits, they ran out of cash. Very simple. Now here's the danger of this. Which other bank has done the exact same thing? Because with interest rates high right now and probably going to be high for another couple of years, the bond prices have lost a lot of value. And all those people that thought, let me invest in something safe up here, government-backed bonds, are now losing their shirt. And if that's a bank, then guess what? There's a lot more than just one bank in danger. So make sure you ask that question to your local bank. If you're a bank with a small bank, make sure you distribute your money amongst multiple banks because only up to $250,000 is covered by the FDIC. So if you have more than that in the bank, you better move it around different accounts because there's a risk that more than one bank will fail.